Hey there, Ed McCormack here, founder of the crypto education platform, Dchained. In today's video, I'm going to switch it up a bit. Usually, we'll spend our time talking about different emerging trends or strategies that you could use in your day-to-day. But I want to spend this video talking about one of the fastest and easiest ways that you could lose all of your money in crypto. You ready? It's called margin trading, or often referred to as leveraged trading. Now, it's a style of trading that is used every single day by professional traders and financial institutions, and it's used often as a means of hedging your position. So if I own a lot of a specific cryptocurrency, I would then take the other side, use leverage as a way of mitigating any of the loss, so reducing your downside. But in saying that, the key words in there were professional traders and professional financial institutions. The reason being is that it is extremely complicated and there's a lot of background information that you need to know. You need to have a strong understanding of the markets, and you also need to have a certain type of risk-reward, adjusted risk type strategy in place in order to use it effectively. Now, what I'm going to talk about now is just to break down what is margin trading so you know what it is, and ultimately you can understand what the implications are, even if you're not directly doing margin trading yourself. So let's talk what margin trading is. At its most simple form, it's basically a loan that you're taking out on the exchange in order to get the exposure to a larger position size. For example, if I only had $500 and I went into Kraken, which offers leverage here in the US, or you can use Binance, Deribit, FTX internationally. If I had $500 and I wanted to be able to get the profits as if I had $2,500, what I would do is I would go into the futures market or any type of margin trading, and I would apply a 5x leverage, meaning that my $500 in effect would be worth $2,500 on that market because I am taking out $2,000 as a loan on that platform. Now, many of these platforms do it all automatically on the background, so you don't even have to start going through the loan process. All you need to do is you generally will go into the drop-down, select what type of leverage you want. Some exchanges go all the way up to 100x, and I'll tell you a little bit about what all that leverage means in a second, but ultimately gives you that opportunity that you can expose yourself to a larger position size, larger holdings in order to get the profits. Now, this is valuable if you know for a fact that this cryptocurrency is going up. Because in that sense, if you're using something like 5x leverage, all you need is that cryptocurrency to go up 20% and you double your money. It's great. But the catch is this. It works both ways. So if it goes down 20%, you lose all your money. Or you'll be required to put in more of your investments, more money into this one particular trade so you don't get what's called liquidated. Liquidated is just simply a term that means that the cryptocurrency has gone down a certain percent relative to your leverage where you essentially have run out of money. And the cryptocurrency exchange will, in effect, close out your position, sell your holdings, and you're left with no money. So going back to that 5x leverage, you would only have a 20% sort of runway before you're out of your cash, you're out of the money. So why is that such a problem? Well, aside from the fact that you need to have a very good understanding of the market on any given day at any given time to avoid any type of instant market correction, which could lead you to lose all your money, it has a macro effect. And we saw that this past February and we saw that this past May. In both instances, we had a point where the market went through a correction, which is healthy, but ultimately, because there were so many investors who were over leveraged, even going up to 100x, as those investors started to get liquidated, the price immediately starts to contract. And it's sort of a domino effect. So you had traders who were in, let's say, 50x. As soon as Bitcoin went down 2%, they get liquidated. Then it starts pushing down the price even further. The next row of people get liquidated, and so on and so forth, and so on and so forth. And ultimately, it creates this artificial sell-off, which in effect impacts everybody. So I'm not saying that you should avoid margin trading or applying leverage. What I'm saying is that unless you have a very deep understanding of different trading strategies, you're closely watching the market throughout the day, and you have just an overall sophistication in terms of how you should be applying and what leverage is appropriate for you, it's probably best that you don't use margin or leverage trading. A better option might be to simply buy altcoins. Just by the nature of how they are dependent on Ethereum, you could argue that altcoins, especially the small and mid caps, are in effect leverage buys in and of themselves. So you sort of get your cake and eat it too. So I hope that this video didn't scare you, but you also found it important and informative. So if you did, like this video, subscribe to this channel, and please come back. I look forward to speaking with you soon.